Okay. So in Objective 2, we're going to look at the difference between those capital expenditures and those revenue expenditures and define them and look at how we're going to cost out some property, plants, and equipment. So, first of all, an expenditure is the payment for or incurrence of a liability. So you can either pay for or owe money to purchase an asset. We can categorize our asset acquisitions as either capital expenditures or revenue expenditures. A capital expenditure is basically going to be a purchase that has a long-term benefit longer than a year. The long-term asset costs are going to include any outlays for the item, such as the plant assets, the natural resources, or the intangible assets, any additions to them, any what we call betterments or improvements to them, and then any extraordinary items associated with them. Then we have also what we call revenue expenditures, which are typically what we would consider to be repairs or maintenance. They benefit more than one period, but they're still going to be expensed in the period in which they're incurred. So let's look at some distinctions between capital and revenue expenditures. An example, the purchase of a machine that benefits the company for several years is mistakenly recorded as a revenue expenditure. The result would be that the cost of the machine gets expensed in one period. The current net income would be reported lower than it should be, so therefore our net income would be understated, and then in future periods our income would be overstated. In this case, if we had a revenue expenditure that was incorrectly recorded, the expenses in a current period would be understated when they should be a little bit higher, and our current net income would be overstated because our expenses are understated, and then our net income in future years would be what we would consider to be understated. Okay, so we've got to be careful to make sure that when we have an asset, if it's got a long-term value, we're correctly recording it as a capital expenditure as opposed to as a revenue expenditure. And then if we've got revenue expenditures, we're properly recording them in the period in which they're incurred. So general approaches to acquisition costs. We're going to look at the cost of the asset equaling the purchase price, any freight that is associated with it, any installation costs, and any insurance costs. All of those would be factored into what we call the acquisition cost. If we have land that we're purchasing, our land is going to cost the actual price of the land, any broker's fees, any taxes that we have to pay to the buyer. So if the buyer paid real estate taxes, let's say we're buying a piece of land in September, and the seller paid the real estate taxes through December. We're buying it in September, so they've paid 3 months worth of taxes, October, November, and December's taxes, when they're not going to have use of that land for those 3 months. So we have to pay them for those taxes that they've paid for up front, okay? Because they're not going to technically own the property anymore. So taxes, and then any costs associated with preparing the land for whatever we would like done on it. So if we're going to put any sewers in, if we're going to put any water lines in, etc., that would all be included in the land acquisition costs. Something to keep in mind, highlight this, circle this, whatever you need to do. Land purchases are not, capital not, depreciated. So land does not depreciate. Anything that goes on the land depreciates, but the land itself does not depreciate. So make sure you highlight that, or some way, shape, or form remind yourself of that.
If you're a farmer and your fields get all dried out.
Okay, so no, that the land technically does not depreciate. If you're a company or a farmer that, let's say,
Used up all of the resources in the school.
yeah, the plants and things of that sort are are basically like inventory. They're going to come and go every single year. So that's not an issue. If you're a company that owns like timber, or you own a gravel quarry, things of that sort, that falls into the depletion category. So that's going to go down in value, okay? But that's a little bit different than just like here our building is on a piece of land. There's nothing that's going to be depleted or taken away from the land, okay? Does that make sense? Does that make sense or no?
Yeah, I mean, yeah, but it makes sense. Yeah.
But what?
It's just, if you had a quarry and then mine all the things out of it.
That's going to deplete. That's going to deplete.
If you go to sell the land, you're not going to get as much for it, which means your land depreciates.
Right, but depletion, okay, so going back to this slide back here. Yes, it is a big issue. It's this issue right here. So what I said to you back here is if you have land that there's natural resources on, they're going to deplete, okay? That's different than this, okay, where you have tangible assets and they're sitting on land, okay? That land does not depreciate. So like us sitting here, our building sitting on this land, the land around us is not going to depreciate in value. It doesn't go down in value.
Like they build a ghetto around here.
Okay, that's a different thing. Okay, so that means the fair market value of the land is going down. It is not the same thing. It is not the same thing. You're talking about the market value of something versus the actual value of the item. Okay, the market value can go down. If the market value goes down, if the market value goes down, you can do a write-off to decrease the market value if you get to that point. But you never really experience that decline in the market value until you actually sell your property. Okay? So it doesn't depreciate the value of the asset, which is meaning the value is the items getting used up in some fashion. Our land is not getting used up by us just sitting here on it. Okay, so there's a difference. There's a difference between it being used up and then its market value going down. Okay?
Got it.
All right. So, general approach to land improvements. You can have driveways, parking lots, fences, etc. Those are considered land improvements. Land improvements can be depreciated. Okay? So you put a fence up on a piece of property, that's an improvement to the land, but that fence can, get knocked down, it can weather, etc. So that will depreciate. It does have a limited useful life. Buildings, generally speaking, the cost of the building and the price to make it usable are going to go into the acquisition cost. If you're buying land and a building, they're going to be held in two separate accounts on your balance sheet. You're going to have an account for the land itself, and you're having a separate account that's going to be accounting for the building, because the building is going to depreciate and the land is not. The building will have an estimated useful life, and the land will not. The building will also include the cost of any labor to construct it, the cost of any materials associated with building it, any construction loan interest, that's going to be rolled in there. Any surveying costs, any assurance, etc., is all going to go into the cost of a new building. You can also have what we call leasehold improvements. So when you go into the mall, okay, you go into the mall, Macy's has space in Crossgates Mall. Any improvements that they do to that space are called leasehold improvements. They become, technically speaking, the property of the owner at the end of the lease. Those leasehold improvements, though, are depreciated. So in a lot of your company's financial statements, the leasehold improvements are noted in the annual reports in that breakout of the property, plant, and equipment. Okay? And so you've got to make note of that. Okay, it's treated a little bit differently than the building itself. When we have equipment, the cost of the equipment is going to include shipping, insurance, tariffs, taxes, any of that kind of stuff, the buying expenses, etc., installation, and then if there's any test runs that have to be done on that equipment, that will be included in the total cost of the equipment. And again, that total cost would be depreciated over the estimated useful life of that particular asset. When we purchase an asset, when we purchase a group of assets, so let's just say I'm a business and I'm going to purchase an already existing business building and all of the stuff that's inside. As I've just spent the last several pages discussing, those items are all treated a little bit differently. So the land is not depreciated. The building may be depreciated. The equipment may be depreciated. But they all have different useful lives. So what I've got to do is I've got to break it out. If I paid $1 million to purchase the land, the building, the equipment, etc., and I paid $1 million, I have to figure out how much of that $1 million is going to be allocated to each of those different categories of long-term assets. Because they're all treated differently. They're all going to be booked into different accounts on your balance sheet, just like you've seen in your own financial statements. Okay? So I must allocate the cost of each item based on the fair market value using an appraisal relative to the total cost of the assets themselves. And we'll do this in a little bit more detail next class, but let's just assume that an appraisal estimates $20,000 for land and $180,000 for a building if they were purchased separately. In this case, if 10% of the lump sum price, or $17,000, would be allocated to the land, and 90% or $150,000 would be allocated to the building. This is how it would break down. So, okay, if I had $20,000 and $80,000 were my appraisal, and the total cost were $200,000. That means $20,000 represents 10% of the total, and $180,000 represents 90% of the total. If I just spent $170,000, I would then break out my $170,000 into 10% for my land and $153,000 into my building. Okay, using that same 10% and 90% allocation, or apportionment, if you will. So if all I knew was that I just paid $170,000, this should be $170,000 in my problem, I'm sorry. No, my 20 and my 180. Yeah, if I just paid $170,000 for this, then I would break it out as 10% and 90%, and do the math: 10% times 170, 90% times 170 to get my allocations for my land and my building. Okay? And we'll work on a problem next class. So we're going to stop there for today.